All right, welcome to week 3 of Mastering Money Management with Urban Forex. Now, in this video, we're going to be talking about understanding ATR, which is average true range. Now, before we get into what it is and how it's important and everything, let me first help you on how to first set it up on your chart. Okay, so I'm using TradingView right here, and there is an option to insert indicators. Okay, you want to click on that, and you will see it just here on your built-in list as average true range. That is the A, the T, and the R, right? If you cannot find it, you can easily just type it in the search, ATR, and you will see it right there. So once you click on that, you have the plot that comes out down here, the ATR. Now, what we're interested in, let me get the marker for you here. What we're interested in is this number right here. Okay, now if you think of it in terms of pips, it's almost like if you're reading this price, we look at the fourth number, right, for determining the pip amount, right? The fourth number. So the same thing is this is displaying the value 9, which is 9 pips. Okay, so let me explain what this means and how it works. Now, what you can do is simply minimize this as much as you can. Okay, this will keep it out of the board because we're not interested in the graph. What we're interested in is the number. Okay, now the couple things you can do. Here's a little tips and tricks that you can deal with this. Is if you're looking at your screen and you have ATR plotted with you, you can double click it to make it disappear. And you can double click on your screen again to make it come back. So that way, if you want to have a clean chart, you can easily do that. Now, if you don't see the values, you can try clicking the plus or minus button. If it's hidden, then the values disappear. But if this is checked as a plus mark, the values come back. Okay? So now that you've put in the ATR, let's understand what is the purpose of the ATR and why is it so important and valuable. Okay? Some of you guys might have different platforms, and as you guys put in the ATR, you will see that it will ask you for an input. Okay, now in this particular input, I've just used the standard 14 length. Now what this means is it is looking at 14 previous candles. Okay, so if I put my mouse right here, I want you to focus on the number here. Okay, so if I put my mouse right here, look at the number, it says 12. So that's 12 pips is the average movement in the last 14 candles. Okay, so if I put my mouse here, the number is 11. The last 14 candles, the average movement is 11. Okay, 11 pips. So now that you know this understanding, when we're looking for a trade, all trades generate from one opportunity idea of give me a better price and I will buy it. Always think of your currency, whatever you're trading, as merchandise. Think of it like you're in the business to acquire the merchandise and sell it again. Okay? You never hold it. Okay, as a trader, that's what you're doing all the time, right? Whether you're in stocks, futures, cryptos, or anything like that, you're not interested in what is the price, okay, how much can it go up, can I hold it for 10 years? As a trader, you're interested in where can I get in, at what point is the merchandise offered for a discount so I can buy a lot of it and then later resell it back once the price goes higher, right? So we're always looking for some kind of a pullback. Now, in a range, you're doing the same thing. If prices are bouncing between, you're looking to buy whenever price comes low again, so you can buy it up and take it up to your recent high, where price may react once again. Now, in the 4-course bundle at Urban Forex, we generally call these resistance areas or support areas landmines. Okay, simply for the terminology of once price gets there, the memory of people of what happened there comes back. So price can re-explode back in your face. Okay, so if you are preparing for prices to come down and roll over as you're getting the discount, and once the rollover is happening, if you enter your trade, you need to know what kind of expectations can you have. Can you say, I'm going to enter here, okay, where I'm drawing my arrow. I'm going to enter here, and I am expecting 500 pips of profit. Okay, why 500 pips of profit? Oh, because it's a beautiful day outside, the sun is shining, I should get 500 pips of profit. My mother told me you will get whatever you want that you think of, my son. Unfortunately, it's not like that in Forex. Okay, what your mom or family members might have told you, yes, that is true, psychologically speaking, but when it comes to trading, you have to be rooted in reality at all times. Okay, now what is the reality at that moment on that candle that you're trading? Okay, if we take a look at that candle and I put my mouse on it, look at the number at the ATR. Okay, it says 12. Okay, so what we're looking for, what we're understanding now is there is an average of 12 pips of movement in the last 14 candles, because that was a setting, right? 14. So there's a 12 pips of movement. If I do the buy, I'm looking at no more than multiples of 2, maximum 3, before I run into a problem. Okay? So what is a multiple of 2 of this? If I trade for 2 specific candles for the average movement, I should be getting 24, right? Should be getting 24. So if my entry is on this price right here, which seems to be 0057, right? 24 pips higher than that is what? 81, right? So 81 pips. 81 pips is right here. Now look at that resistance area. Now if you go with the multiples of 2, you will generally end up around the area of where the resistance is happening. Now, why does this happen mathematically? Very frequently this happens mathematically. Because when you do your 2 ATR, or 2 multiples of your ATR, you generally thereabouts reach an area of resistance. But why is this number coinciding time and time again? Why not 10 ATR? Why not 50? Why not 1? Why is this number 2 seems to be the average number? Because when you're in a trend like this, when you're dealing with a trend like this, anytime you get a pullback, generally the pullback speed that initially comes in very, very hot. Okay? Now you need that discount that's coming in very, very hot to slow down. Okay? Now, let me give you an example. Let's say this is the price of Apple stocks, right? Okay? Let's say this is the price of Apple stocks, and you're looking to buy Apple stocks because you're noticing this nice little uptrend that's been coming in, but you're like, I can't buy it at a very high price. I gotta get a better price. Okay? I gotta get a better price. So Apple starts to give a discount on their stocks. Or, okay, if you want to use a different terminology, the prices are reacting. Whatever happened in the market, buyers and sellers, the buyers release the gas pedal and the prices are starting to drop a little. Now, as buyers and traders in the market, you're looking at this as, oh, good, opportunity is starting to come in. The people who were already buying before you are looking at this area of, oh, looks like I made some decent money. Let's get out. Let's get out. Let's lighten up. Let's remove some of our positions. Let's lock in our profits. These generally happen around normal SNR areas where previously the market turned around. So this is like the market memory, right? If you want to call it a memory. So these memory areas are generally something you want to get an idea of, can the market react again? We call these areas landmines in the 4-course bundle, right? These memory areas, because the prices dramatically respond to these levels, okay? You can also call it the extreme support and resistances, the ones that are very far away, the extreme support and resistances. So in this case, once the prices are coming down, buyers are looking at this as an opportunity to buy, but you cannot buy yet because panic has just come into the market and people are going to begin to sell. As the panic continues, the selling continues, and the buyer is getting more anxious, like, oh yeah, look at that price. It's even better now. It's even better now. We are now approaching support and resistance, which will make many traders activate the trade. We are also reaching Fibonacci numbers, which will make many traders also activate the trade, because that is all location-based trading, right? Supply and demand, Fibonacci numbers, support and resistance. But you're looking at it in a pure sense of market rhythm, right? And you're looking at this as, okay, it's coming down, it's coming down, it's coming down, and then the slowdown happens. The slowdown causes your ATR numbers to adjust. Okay, if I put my mouse right here, you will see the number seems to be average 10 to 12. And then if I go on to this red candle here and green candle, the numbers go up to 13 and 14 even, right? Now the numbers are getting high. They're getting 13, 14. Now, if you were to buy any of this stuff at these prices, okay, let me remove this. If you were to buy any of these things at these prices, so let's say you activate the trade in this area where the 14 came in, okay, which is this price right here. Okay, candle close on this red bar, and the next bar you hit the buy, and you have the price of 53. Now, 14 with the multiple of 2 puts you at approximately 28 pips, right? Okay, 28 pips is your average movement to do the buy. So from this price at 53, if you add the 28 to it, you're looking at 73 for 20, and then you add additional 8, you're looking at 81, right? So 81, yet once again, puts you back at this recent high. So these R multiples are always going to throw you at these recent highs where you're going to come into some problems, okay? Potentially come into some problems. These are the areas where the market will look at this as a memory and saying, it went down last time, it can possibly go down again. As a trader, you are trying to use this area as your exploitation area, okay? You're getting in and you're lightening up at this area with the ability of, can it go further? Let's see. But target number 1, that recent high, okay? Otherwise, it can jump right back at you. All right. So if you take a look at this in the whole sense, okay, let's assume you're looking at this major downtrend and you're like, okay, I can see it's crashing. Okay, everyone's getting rid of the merchandise. Give me a better price to get the merchandise, and then I'm going to sell it off later as well. Okay, so you can buy a bunch of that merchandise, you can take it and you can resell it later to turn a major profit off of it. Okay, so what's going on here is you're looking for prices to move back up. And in this sense, when you come to these areas as a rollover is happening, notice your ATR numbers is shifting to 9 to 10 to 9 to 10. So anywhere in this area, if you're looking at anywhere from 12 to 10, if you take 2 multiples of that, we're looking at 20 to 24. So assuming you took any price in here, okay, which is now 46 price, right? This line that I drew is the 46 price. If I subtract 20 pips from it, we're looking at 26. Okay, now where is 26? 26 is right around this area right here. Now notice how your recent low is supposed to be here, the major memory. That's supposed to be your target area. But notice because the ATR is so low, it's telling you there's going to come some complications along the way. But these areas that you mark seems to be areas of support. Okay? These seems to be areas of support. So if you do take the trade, be aware of these areas because your ATR is telling you the current average movement is not for far distances. Okay, the current average movement is not healthy enough to take you very, very far distances. So having expectations to say, I'm going to take it down to 9950, okay, going from 0050 approximately, that's 100 pips down, right? 94 pips down to be exact. So having that sort of expectations is too high, and there's going to be a lot of conflict in between, okay? Your smoothest ride is going to be 2 multiples of the ATR, and then that thing ends. It may bounce, and then it resets again, okay? And then the activation comes in a little bit more later on, and the prices go up to 14, okay? If you reactivate your cells from this price, but now your ATR is 14, you're looking at 28 from the price of 40, let's say, okay? So 28 less than that, we're looking at 20, we're looking at 12, all the way down to price number 12, right around here. You're looking at some sort of a reactionary area here. Now look at the 2 ATR at this price. It doesn't seem like it's support and resistance, but if you look carefully, it actually is. Look at that. Okay? So what an ATR is basically every pair that you're trading or every merchandise that you're trading, they will have their unique characteristics. It's almost like their DNA, right? You're reading their DNA of what is the average movement? What is the characteristics of this specific thing? And it helps you to identify, okay, if that's who this thing is, if that's who the characteristics of this merchandise is, then having expectations beyond that is not rooted in reality. It is just hope. Okay? So I hope that makes sense. Let's proceed to the next video.